So, as you may already know, this is our second episode on the Forex and crypto trading tutorial. On the previous episode, we talked about fundamental and technical analysis, which is the base of trading. And we discussed that technical analysis is the use of chart patterns, indicators, and candlesticks to predict the future prices of an asset. And fundamental analysis is the use of economic factors, news, and trends surrounding an asset to determine the future prices of that asset. Everything we discuss about fundamental analysis is all you need to know about fundamental analysis. I mentioned that our focus will be majorly on technical analysis, starting with candlesticks. When you look at the chart, the first thing you see is candlesticks. Some are red and some are green in most charts. Some have long tail, some have shorter tail, some have big body, some have smaller body. Now we need to know the reason behind these things by knowing how they are formed. Traders believe that the market movement is not random, it follows a pattern, and if you can spot those patterns, you can easily predict the market direction. Now the first approach towards knowing these patterns is knowing your candlesticks. Each candlestick on the chart, regardless of its color, green or red, represents one complete movement of that particular asset within a selected time frame. What this means is that if a trader decides to select 1 hour time frame on the chart, each candlestick then represents 1 hour movement of that asset. If the trader decides to select 4 hours time frame on the chart, each candlestick then represents 4 hours movement of that asset. For instance, on the 1 hour time frame, a candle starts forming by 8 a.m. It stops by 9 a.m. and another starts forming immediately. After 10 a.m. it stops, another starts forming immediately. Now what determines the color of these candles is the price at which the asset was when this candle stopped forming. Using Bitcoin as an instance, if the price of Bitcoin was at $30,000 when a candlestick started forming on the 1 hour time frame, and after the candle stopped forming, Bitcoin was trading at $30,200, the color of this candlestick will be green, showing that the opening price is lower than the closing price. That is, the closing price is higher than the opening price. The price opened at $30,000 and closed at $30,200. This makes it a bullish candlestick, that is, green candlestick. When the candlestick is red, what it means is that the asset traded at a price lower than the price it was trading when this candlestick started forming within the selected time frame. Using Bitcoin as an instance again, if Bitcoin was trading at $30,000 and a candlestick forming on the 1 hour time frame stopped forming while Bitcoin was at $29,900, which is lower than the opening price of $30,000, the candlestick is bound to be red, that is bearish. Don't get confused when I say bullish or bearish. When the market is in an uptrend, it is called a bullish market. When the market is in a downtrend, it is called a bear market. Now in a bear market, there are more red candles, and each of those candles are called bearish candlesticks. In an uptrend, there are more green candles, and each of those candles are called bullish candlesticks. This is why after halving, Bitcoin starts pumping, and when it starts pumping, there will be more buyers in the market. These buyers are called bulls. This is why we have bull markets. In other words, the bullish market comprises of more buyers, and those buyers are called bulls. A bear market, that is a downtrend, comprises of more sellers, and those sellers are called bears. There's actually a funny reason behind those words, that is bulls for buyers, bears for sellers. Now, a bull is known to thrust its horns upwards, representing rising prices, and a bear is known to throw its paws downwards, representing falling prices. Now this is how we arrived at bulls for buyers, bears for sellers. As the candlestick form and take different shape and sizes, each of those candlesticks has its own name and passes its own message. We have the candlestick called pin bar, and because of its shape, some people call it hammer. This candlestick usually forms at the bottom of a downtrend, signaling the emergence of buyers in the market. This candlestick is so bullish that in its red form, it is still considered a bullish candlestick. Now, because it is widely known as a strong bullish candlestick, it is often a tool for market manipulation. Sometimes you see a pin bar and the next thing you see is a big dump. So you have to be careful with this particular candlestick when trading. Another candlestick is the inverted pin bar or inverted hammer, which is antonymous to the pin bar itself. This usually forms at the apex of an uptrend, and it's a signal that an uptrend is already losing its momentum. So you have to start preparing for a pullback or a reversal in trend. Another important candlestick is the bullish engulfing candlestick. This comprises of two candlesticks with one green completely engulfing the smaller previous candle, which is red. A candlestick that is antonymous to the bullish engulfing is the bearish engulfing candlestick. This also comprises of two candlesticks with a bigger red candle completely covering or engulfing the previous small green candle. This often appears at the top of an uptrend and is a signal that there will be a reversal in trend or a drop, pullback or retracement. Another candlestick is the doji. It has the shape of a cross or plus sign. It's a neutral candlestick, an indecisive candlestick that signifies there was no winner between buyers and sellers during its formation. A doji candlestick has almost the same opening price and closing price. These are not the only candlesticks, there are still many more, but these are the major ones, and these are the ones you are most likely to come across throughout your trading journey. But if you still wish to know about the other candlesticks, I listed some of them in my Telegram channel. The link is attached to this video. Candlesticks alone are not enough to predict the direction of the market. You need to consider other factors like support and resistance to properly forecast the direction of the market. Why did I say this? A pin bar can be used to lure in buyers during a downtrend and get them messed up. An inverted hammer can also be used to scare away traders during an uptrend. How does this happen? When a pin bar forms during a downtrend, traders, especially the newbies, tend to jump in and start buying without knowing if there's actually a support level at that area. And if there's no support level and at that area, it means that the pin bar is a trap. It's not the time to buy until there's a support level, and within this support level there's a candlestick showing upward momentum. As a trader, you must have had someone say, I bought the dip but it's still dipping. That was what I meant by catching a falling knife. A dip is not enough to consider buying. A candlestick is not enough to predict the direction of the market. A downtrend does not mean you should buy, and you must never sell except it's a resistance level. Resistance level within which you have seen a bearish candlestick. This means that they all work together. You have to put everything together to arrive at a decision. You cannot buy because there's a support level. You cannot sell because there's a resistance level. And you have to buy because there's a candlestick formation within that support level, and you have to sell because there is a bearish candlestick within that resistance level. They have to work together. In the next episode, we must talk about support and resistance to help you properly digest everything we've said regarding candlesticks. In order not to miss out on the next episodes, follow this page, turn on your post notification. It's a free tutorial. The least you can do is to like and share the video so others can see it and join us. Well done.